Hello, good morning and good afternoon, everybody. It's September 11th, Thursday. Welcome to our weekly edition of Morgan Stanley's Asia Macro Webcast. My name is Derek Gum. I am the Asia economist, and I'm very pleased to be joined by my colleagues, both economists and strategists, to discuss policy, the economy, and the markets. And please note that this event is for Morgan Stanley's institutional clients and financial advisors only. This event is not for members of the press. If you are a member of the press, please kindly disconnect and reach out separately. Please note that this webcast and your question may be recorded. And during this webcast, please feel free to ask us a question anytime from the Ask a Question text box. So now with that, let me kick off today's debate. Chee Wong, I want to first turn to you to talk about the US. Obviously, there's been a lot of attention about the weakness of the labor market data. There's also sort of like a debate about how quickly and how much will the Fed be actually cutting. Would you be able to share your thoughts, your latest thoughts on how you see the Fed policy path evolving from here and how they might actually influence the economy? Chee Wong, over to you, please.
Thank you, Derek. So let me talk about the U.S. situation, and the conclusion is very much straightforward. We have been expecting the Fed to start cutting rates on a quarterly basis from September. However, based on the latest labor market data, not only September and December, but also an additional cut in October has now become a possibility. I would also like to emphasize that our base case scenario carries a 50% probability, while the optimistic case is at 20%, and the downside scenario at 30%. In other words, our outlook remains slightly tilted to the downside. So let me start from the U.S. labor market. U.S. labor market is now in what could be called a no-hire environment, which is characterized by sharply slower job gains and very few layoffs. Since May, non-farm payrolls have risen by only about 227K per month on average, a drastic downshift from roughly 120K per month pace earlier this year. The goods producing sector led by manufacturing has lost about 42K jobs over the past 4 months, yet the unemployment rate has only edged up to around 4.3, remaining historically low. As a result, any increase in labor market slack has been very gradual, and we see no signs of widespread layoffs or surging flows from employment to unemployment. The main reason for that is immigration restrictions. It has effectively tightened labor supply, which in turn has helped keep the unemployment rate low. For instance, labor force participation among foreign-born workers have been declining, and slower net immigration has further curbed labor force growth. Consequently, the monthly job gains needed to hold the unemployment rate steady, which is the break-even pace, has fallen from roughly 210K last year to about 125K this year, and it could drop to around 70K by this year end. At the same time, restrictive trade policies such as higher tariffs, as you know, are creating a structural drag on business activity and potential growth, which is another factor that could justify more aggressive monetary easing. And please remember that this structural drag from the tariffs will just take time. CPI was more straightforward, but the drag on businesses actually usually takes a bit more time. So this slowdown in hiring and the slight easing of labor market tightness and also weighing on the economic growth. And our U.S. team's tracking estimate for the U.S. GDP growth in the third quarter of 2025 is around 1.5% annualized pace, which is a modest pace even after a recent upward revision. The outlook reflects an expected sharp slowdown in consumer spending in August and September as tariffs erode household purchasing power and job income growth weakens. In fact, aggregate payroll earnings for all workers have slowed to around 3.1% annual growth rate recently, and faster inflation is cutting into real income, raising the likelihood of further softness in consumer spending. So against all this backdrop, the Fed appears poised for a policy turn. So market expectations have shifted toward a more than 100% probability of a rate cut in September, and Fed Powell has indeed signaled a likely 25 basis point cut at the upcoming meeting. The latest employment data has further bolstered the case for roughly 75 basis points of total rates cut by the end of this year. We, for now, maintain a base case of quarter point cuts in September and December of this year. However, if labor market weakness persists, the Fed could opt to cut rates at every remaining meeting, meaning September, October, and December. We currently project the federal funds rate to bottom out around 2.75 to 3%, which is the terminal rate we are thinking, which is slightly higher than earlier forecast, but broadly in line with the market pricing. We just think that the market has finally come around to our view to a lower terminal rate in the upcoming easing cycle. This cyclical and structural drag on activity and potential growth from restricted trade and immigration policy justify a deeper cutting cycle than the markets and the Fed have been projecting. And back to you, Derek.
Thanks a lot, Cheung. We'll come back to you on questions later on after the speakers have actually finished their presentation. I now want to turn the spotlight over to Japan and over to you, Masa. We are having a BOJ meeting that is upcoming, and we've also seen the recent political developments. How are the two actually going to interact with each other? And also, what does it mean for the economy? What does it mean for the policy path going forward? Masa, over to you, please.
Yeah, sure. Thank you. So over the last weekend, the political situation has changed and attracted a lot of attention from the market. Prime Minister Shigeru Ishiba held a press conference at 6 p.m. Japan time on September 7, announcing his intention to resign. Given the growing cost within the ruling LDP for an extraordinary leadership election, many domestic investors had already anticipated that Prime Minister Ishiba would eventually announce his resignation. So this announcement may not be a major surprise. So at this point, the media is reporting several names as potential successors, including Shinjiro Koizumi, Minister of Agriculture, and Sanae Takaichi, former Minister for Economic Security, Yoshimasa Hayashi, Chief Cabinet Secretary, Takayuki Kobayashi, former Minister for Economic Security, and Toshimitsu Motegi, former LDP Secretary General. So many investors, especially foreign investors, believe that if Takaichi becomes the next prime minister, fiscal and monetary policy may shift toward expansion. But that said, the Bank of Japan Governor Ueda is focused on hard data from the U.S. at this point. And following the latest August employment stat in the U.S., it appears that the bar for a rate hike by the BOJ has increased regardless of the political situation. At this point, various news media started to report about upcoming election increasingly. The LDP decided to hold the leadership election as so-called full-spec format, which includes the votes from party members. Voting and voting counting is scheduled for October 4th. Given a full-scale election will be held, then foreign investors seem to pay closer attention to Takaichi's policy stance, given her strong support among regional party members in the previous leadership race. In such a format, candidates' economic policy positions will likely be clarified through the debates and other events going forward. And then afterward, the prime minister will be elected in the diet. If no candidate secures a majority, then a runoff between top two candidates will be held, making it likely that the LDP president will become the prime minister. In any case, it would be quite important to track various communications from candidates for upcoming LDP leadership elections. Then, of course, this kind of political event would have the implications for the monetary policy. So let me move on to the monetary policy. So every few months, we seem to go through a cycle where there is renewed attention over the BOJ's next move. By and large, we think most investors seem to lean toward the view that the BOJ needs to hike sooner rather than later. At this point, market participants show strong interest in October BOJ policy meeting. That said, we think that October rate hike is still premature. Governor Ueda has already shown his cautious stance in the latest monetary policy meeting in the end of July. As this presentation slide summarizes, now, for example, he said, we want to observe how tariff policies affect hard data such as exports, production, and employment in the U.S. And we believe that the global economy, including Japan, is heading toward a slowdown, and we want to assess the extent of the deceleration given the high uncertainty. The key question going forward is what kind of impact those tariffs will have and where exactly those effects will manifest. Therefore, I think it is unlikely that the fog will clear up all at once. So we think confirming the impact of tariff on the global economy, including the US, will require time and validation through the hard data. We have started to see some potential signal that tariffs weigh on manufacturing earnings ahead. We have impression that the BOJ would likely to wait for more hard data. For example, in the Ministry of Finance corporate stats for April to June 2025, recurring profit in Japan's domestic manufacturing sector declined by 11.5% YOY, marking the second consecutive quarter for the profit decline. And then notably sharp drops were seen in the transport equipment and steel, which are being negatively affected by the US tariffs. Although multiple factors may be contributing to the widespread decline in profits, the impact of US trade policy is considered particularly significant. If the negative impact of tariffs continues, then in next year's spring wage negotiation, so-called Shunto, some manufacturing sector may see labor unions make modest wage increase demand out of consideration for business performance, or even if unions push for aggressive wage hikes, manufacturer management may be unable to fully meet demand. Ahead of October monetary policy meeting, key events would be the BOJ Tankan survey and the regional branch managers meeting held in early October, and also the implications, especially like a fiscal policy side, from the new upcoming prime minister going forward. Also, what kind of communication strategy the BOJ would use going forward. Especially like the BOJ side, we have impressions they would have high incentive to lay the groundwork for the rate hike in advance. That would include not only board members' speeches, but also communications utilizing, for example, interviews held at the BOJ headquarters exclusively with major news media, and the so-called off-the-record briefing session by the head of Monetary Affairs Department or Deputy Governor. In any case, going forward, there will be many events and data points we need to pay attention to, but we would like to monitor all of them to get the policy implication going forward. Let me stop here and back to Derek.
Thank you very much, Masa, for the overview. Now, still staying on Japan, but then now moving the focus towards the macro markets in terms of the JGB market and also the yen outlook. I want to bring in Sugisaki-san into the conversation. Sugisaki-san, can you help us to sort of understand and break down what has been happening in the FX and rates market, and how do you see things going forward from here?
Yes, sure. Thanks, Derek. Let me start with the yen rates market. I think the political uncertainty is obviously the main focus in the market. And the PM Ishiba-san already announced his intention to step down, and the market increasingly focus on who will become the next LDP leader and the subsequent possible fiscal expansion. According to the news article, a new LDP leadership election will be held on 4th October with a full spec form. And as the Inui-san already mentioned, the market broadly acknowledge the fact that the Takaichi-san got the more vote than the Koizumi Jr. at the previous LDP leadership election. So the market seems to see the decent probability of the Takaichi's win on the upcoming LDP election. So investors broadly acknowledged that the Takaichi-san is actually favoring the high pressure economy, and the market basically speculates that her winning, which opened the door for the large fiscal expansion. That's why the JGB curve twist steepened after the announcement of the Prime Minister Ishiba-san's resignation, as the market increasingly saw the risk of fiscal expansion under the new administration. We think such a fiscal concern remain intact at least until things become clearer at the 4th October. Like the long-end JGBs has been mainly held by the overseas investors who are the most sensitive to the fiscal story. And recently, the 70% of the recent trading volume in the long end was occupied by the overseas investors in absence of the domestic investors' demand. So we continue to see the risk of the JGB curve to steepen further, not because the further fiscal concern to be priced in, but because weak supply demand in these sectors, as the domestic investors would rather become seller on this turn. We think the Japan Rifles, who are one of the structural buyer in the long end, would become even seller of the long end JGBs ahead of the fiscal half end. Japan Rifles face a rise in the insurance surrender risk as the long end JGB yield rises. And the such increase in the insurance surrender risk would likely require the reduction of the duration exposure on the asset side to make the economic solvency ratio stable. So we expect the rifles to sell the off-the-run JGBs to reduce the duration exposure on the asset side and to take profit the equity holding at the same time to offset the realized loss from the bond selling ahead of the fiscal half end. On top of that, we also see the less support from the pension fund to buy the JGBs, given the relatively benign equity performance, particularly on this August. Overall, we basically saw the long-end JGB's demand only comes from the overseas investors, and this made the long-end JGBs particularly vulnerable when the fiscal expansion is anticipated. On the other hand, we see the ample room for the less than 10-year JGB to rally from here. BOJ's primary reaction function seems to be the US and Japan economic development in response to the US trade policies. As the BOJ Deputy Governor Himino-san recently emphasized this point, and we recently saw the clear slowdown in the US labor market, as Chi-Wung already mentioned. And it's also the case for Japan, as the Inui-san mentioned, Japan's production and export are already decelerated. And our U.S. economists now increasingly see the risk of the 3 cuts this year if the U.S. labor market data continue to show the another softness. Under such situation, I think the market will continue to price out the near-term BOJ rate hiking cycle pricing. So we think the market still not fully rolled out the chance of the BOJ to hike the rate this year. But once the domestic food inflation broadly decelerates, they would discourage such optimism. And like rice prices inflation and eating out inflation already show some slowdown on the latest Tokyo CPI data. So if the market broadly recognizes that the BOJ may be difficult to hike the rate for the foreseeable future, we see the banking community to restore the duration exposure aggressively, particularly in less than 10-year space. So we basically see the 10-year JGB yield to have a lot of room to rally from here. Let's move on the FX space. We see the risk of the dollar yen materially lower from here. Dollar yen has been traded currently very rich against the implied fair values coming from the US terminal rate pricing of 139. Such divergence has emerged from this August, and the intraday price action suggested most of the dollar yen rally has happened on the London morning. So the interesting evidence is that the dollar yen actually have declined during the London afternoon, which means like a New York morning when the U.S. economic data are typically released. So and the dollar yen actually have responded negatively on weak U.S. economic data on this time period, but the rally in the London hours have offset the most of such weakness. So London morning price action recently have a very strong correlation with the CFTC leverage funds net yen positioning data. So I think the leverage funds have been the main culprit of the recent resilience of the dollar yen, particularly in the London hours. Now their positioning shifted from the yen long side to the short side during this summer. So I think this type of positionings are main reason for the resilience of the yen. So, but I think such kind of a speculative yen short demand was mainly due to the benign growth global risk sentiment, and as well as the dovish BOJ's communication and the speculative of the fiscal concern. But once the U.S. economy starts to slow down from here, I think the such kind of positioning which likely unwound in the future, particularly once the global risk sentiment become worse. In such a case, the dollar yen could converge towards the implied fair value of the 139. So within a relatively short period of the time. So given the kind of risk, attractive risk rewards, we continue to see the short dollar yen positions from here. I'll stop there and back to the Derek.
Sure. Thank you very much, Sugisaki-san. That wraps up the conversation on Japan, and I want to turn the conversation over to Korea. Kathleen, I want to start with you. You and June published a report looking at the first 100 days of President Lee's presidency, and you've sort of been highlighting sort of his early accomplishments and what has been sort of shaping the key policy direction. I think, can you give us a sort of like a roundup of what has already happened? And I think also more importantly, what do you think is going to happen next and how that will affect the economy? Kathleen, over to you, please.
Great. Thank you very much, Derek. Good morning, everyone. So today marks the 100th day of Korea's new President Lee since he came into the office. Looking back past couple quarters, since the local political unrest throughout the first half of this year, to the snap presidential election in June, and now well into the third quarter of the year, we think the Korean economy and the markets have come a long way. And we think it's worth highlighting the early accomplishments and our thoughts on the new president and the government policy direction, and share what we think are the next important events in terms of the economic and market reform policies at this point. In the past 3 months, we think the new president has made quite a notable shift in the economic policies. He's also done quite a job in making major push on the reform agenda. And among many policy areas, we are highlighting 3 where we think have been broadly positive, especially for the economy. So one, a quick shift to the expansionary fiscal policy to support the domestic growth recovery. It is very true. The president had inherited a very weak economy. On a wider macro level, we did have the Korean economy contracting in the first quarter, especially driven by the slump in the construction investments and a very tepid, below trend consumption growth that's been ongoing for 8 consecutive quarters. And after President Lee came in, he was very swift to push consumption stimulus. He was very quick to push the second supplementary budget, which came with a major focus on reviving the domestic sentiment and normalizing the household sector consumption activities. And with the direct consumption vouchers and the policy support for the SMEs and small businesses, by July, we actually did see the retail sales showing incremental recovery path bottoming out from the first quarter. And the second quarter GDP also did show that the sentiment recovery had helped with the consumption showing a bit of an acceleration, which guided that further recovery is possible in the second half of this year. And we also note that the domestic sentiment had recovered quite strongly. I mean, during the first half of this year, we've seen the consumer sentiment level going down to as depressed as the level similar to what we've seen during the pandemic. But from the second quarter and the third quarter now, with the consumption voucher distributions, first round now done, the consumer sentiment, especially on the current domestic conditions and the domestic economic outlook, had improved the most, showing a very strong onset for the recovery path that we could expect on the consumption going forward, which we do think the president has done a positive work on the consumption front. And for next year, too, the expansionary fiscal budget that's been introduced last week from the Minister of Finance and Economy and Finance shows a very large spending plan for next year, much focused, 37% of the budget focused on the domestic economy boost, household sector recovery, and the local business revitalization. And on top of that, we also seen the AI investment portion, the R&D, the SOC infrastructure spending being increased. So a broad-based spending increase, we think, should be positive for next year's GDP rebound for the economy, where we're expecting a rebound to 1.5% from 1.1% this year. Second area we assessed the president has done pretty well was, of course, on the trade deal side. Reaching the trade deal on time at a competitive 15% tariff rate, we believe was a case where we really been the case that we avoiding the worst for Korea, especially the Korea's trade deal coming after the European deal and Japan. Korea was facing really tight deadline for before Korea was faced with the reciprocal tariff rate at 25%. But the government and the trade negotiators have done a very swift job on time, reaching the deal, committing of a 350 billion investment package, which was well in an expected term, although the size did come a bit larger than the initial expectations. But the fact that the Korea had avoided the 25% reciprocal tariff and had come to a leveled ground with its largest export competitors in the U.S. markets was a very much of initial positive accomplishment we'll point out. The fact that the timely deal being reached was quite important. Third area, we will say the domestic housing market and the very rigorous credit control measure that came in end of June, we assess as a positive response to the local housing market that was successful to delivering the initial calming down of the excessively heated house price trend move that we've been observing around Seoul and the metropolitan areas. I mean, the follow-up measure, we will follow up on that, but the initial measure we think was a very timely and rigorous and was effective in calming down the market. And of course, as the one of the largest concerns on the Korea's economic structure, including the household debt accumulation, this showing a very a strong commitment to address the structural problems such as household debt. We think from the message from the government was very strong, and we think that was another area that was very positively delivered during the first 100 days of President Lee. Just moving on to the areas that we do still, however, feel the concern about, and we do expect the next follow-up events to make major implications on the economy and markets before I hand over to June on the market reform front would be first, the follow-up on the trade deal. Korea still faces, although the agreement had been reached at 15% trade tariff rate, Korea still faces 25% auto tariffs. And especially when Japan had reached the signing of the executive order by President Trump last week, Korean automakers are now facing tremendous pressure with the higher tariff rate, and that bringing that timing as soon as possible for Korea to have that effective 15% auto tariff rate, we believe it'd be very imperative in sustaining the export growth momentum in the second half of this year and onward. And the second area is the real estate market measure. Of course, the initial credit cap measure we believed was very timely, but the second measure, which just came out over the weekend, which focused on increasing the size of the supply, and also a bit more squeezing of the chonsei lending and the demand side, we feel that it came with a slight sense of delay. And from here, the timely execution and the speedy construction push on these supplies, especially in the core Seoul and metropolitan areas, would be key in continuing the momentum in suppressing the excessive demand on the housing market, and hence stabilizing the housing prices in the capital city and the surrounding areas. And just last part would be, of course, I'll hand over to June, but the initial optimism that appeared to be fading after the first month that President Lee came into the office, along with the proposed tax revisions that the Ministry of Finance has made. We do see a bit of a reignited sentiment or expectations on the measures, but sustained momentum, which is actually quite critical in pushing the market reform along with the domestic structural reform coming, such as encouraging reallocation of the skewed asset in the housing market, the household debt accumulation, and also the aging population and the low fertility rate are all linked to the market reform that could potentially resolve the long-term struggle or structural issues that Korean economy is facing. So we do think showing a strong commitment and follow-up to the market reform had been swindling a bit recently, but continued momentum we will see with the further execution of the tax revisions and further market reform agenda that the government should be able to come out with in the months to come. I'll stop here and pass on to June to follow up on the market reform comments.
Yes, thank you, Kathleen. So after a strong surge for KOSPI about 3,000 level, it's been, it was pushed up largely because of the political stability and the push on the reform, but the market got into a bit of a rut, trading between 3,100 and 3,200, largely because this the value up, or now called KOSPI 5,000 story, kind of met a hitch, and that was really the major shareholder criteria linked to the capital gains tax. Now, this kind of came from the left field, and hence surprised the market. And probably, the watering down of the dividend tax reform was something that probably what the market was more concerned about at that point. So, so 2 months kind of passed, and this week we had a bit of a change in the sentiments because on Monday there was a news flow that potentially the major shareholder criteria could get resolved within this month. And then on Tuesday, there was a news flow about potentially finding a middle ground. And yesterday, there was news that the president intends to keep the shareholder the major shareholder criteria at 5 billion. And so, we have had a very strong lift. It was mainly led by the financials, with the brokers leading the way, and also the banks, which again makes a lot of sense considering that the benefit is more to the financials, especially the brokerage business. But again, this is more about the sentiment boost, and probably importantly, the message that the government and also the ruling party cares about the market and is listening to the market is probably the message that was kind of delivered. Now, what's next up on the reform agenda? Well, next up is going to be the treasury share mandatory cancellation. That was in the news flow probably like 2 weeks ago and a week ago. and it led to the holdcos again rallying. So it's somewhat, I think, somewhat reflected in the share prices right now for the holdco side and the treasury share stocks. But what we're waiting for is more details, especially on the existing treasury shares. And the most loose, I guess, proposal out there among the five is for a 5-year grace period. I think the tightest one is 6 months. So I think the market is expecting somewhere kind of middle ground here, like a 1 year or so. So that is probably going to get done in September. And as I mentioned, it's kind of partially priced in. So maybe not a huge rally from here, but again, there could be more upside. Then the tax reform related to the dividend side is probably going to be key. And really the main difference between the original proposal that was out there was the last bracket of 300 million won or more of dividend income, where the tax was supposed to be at 25%, but the final proposal is at 35%. So whether that gets adjusted down or not will be the key from here. And for the Capital Markets Act revision, it's something that we expect more for 26 rather than this year. So if you look at the cumulative rate of change analysis for the market, the market's largely been driven by expectations, and hence the multiple re-rating has really been the story. But if you look at it on an earnings or ROE standpoint, it's not really been a factor. So what we see from here is that policy execution and corporate fundamentals probably matter more. And if you look at the corporate side of earnings, we don't think that the tariff impact effects and policy is all right now kind of reflected in the earnings. And after the second quarter, we have seen earnings being revised down for 25, but nothing for 26 yet. So we do need to look for that. And that's where I think the difference is between the Korean corporate sector and the U.S., where the U.S. is corporate sector showing a very sizable pickup in revision breadth, while Korea is still not. And the growth dynamics still looks stronger in the subsectors where there's industrials, K-beauty, K-food. That's where we're still seeing, I think, more kind of upside. And just going to the tech side, because it's such a big sector, bit of a change in the view where a lot of the focus has been AI and HBM, but it seems like the focus is now moving a bit more towards the traditional chips like NAND. And we believe that the hyperscalers are going to show increasing demand for NAND linked to the AI, kind of the servers. So kind of a new story coming up. And that's why we like Semco at this point. And so one of the things that we've been kind of saying is that if there is a cycle progression, we could probably see autos and non-semiconductor tech actually make a move up. So maybe this is kind of one of the signs here. So just to end, we think KOSPI is going to be trading somewhere in the range of 3250, which is our target KOSPI right now. Our bull case is 3500, and for that, for further re-rating, policy execution and fundamentals is the key. And for our sectors, we're still liking industrials, the staples on the K-food and K-beauty. We also like internet portals, and we also like financials, with securities being the top, and then followed by banks and insurers. Let me stop here and hand it back to Derek.
Thanks a lot, Jun. That wraps up the presentation by our speakers, and thanks a lot for that. I have a couple of questions for the speakers, so just please play with me for a bit more. Chi-Wong, I wanted to start with you first. You laid out very clearly the path for the Fed, but what can really change that? What gets us to potentially the Fed thinking about a 50 basis points cut in September, and then the terminal rate as well, right? We sort of have this view that terminal rate is going to come. It's sort of where the market is, roughly thereabouts. What would be the key factors that would influence the markets and our thinking about the terminal rate in the US?
Thank you, Derek. So the first one, what takes us to the 50 basis cut in September? We only have like 5 days when we will have only limited information. We have CPI, but CPI is not going to be enough, meaning that because CPI is just a hurdle, that which is prohibiting the Fed to do more. But we already have the employment data, so the hurdle is very, very high. CPI, very weak figure is going to be the one, but we already have PPI, and we are expecting the core TCE to actually accelerate from the last month. So the hurdle may be very, very high. So I think we can stick to 25 basis point cut there. What about the terminal rate? It's going to be dependent on the cost because if the inflation is coming down, not accelerating more than what we expect, then it's not the real economy side. It's more like an inflation side. Then we may not have to change our terminal rate thinking. But if the cause is the weaker employment rate, that means employment, including the non-farm payroll, as well as the unemployment rate, that means the real economy is slowing down more than what we have been seeing. So in that case, to support the economy, terminal rate should come down even further. So it will be dependent on the cost.
Got it. Thank you very much. I think, Masa, a similar sort of question to you as well. Again, you've sort of very clearly laid out the case why the BOJ is not going to be in a rush to actually hike interest rates. But if we do get to that risk scenario of a rate hike happening, what is sort of like a likely timeline for that to happen? And then also, if we do get this rate hike, what would be some of the economic implications that investors should be mindful of?
Yeah, sure. So our base case is it's very cautious stance. So our U.S. economist team maintain its view that the U.S. economy will slow down going forward, as Chiu mentioned. The primary due to the impact of tariffs, and then based on this shared global assumption, we expect the BOJ to keep its policy unchanged through our focus horizon, which extends to the 2026. That said, if we look at the BOJ's communication and the recent development in the research results published by the BOJ, we also have impression that especially policy planning department, like monetary affairs department, is working on creating a logic for justifying the rate hike under this environment. Let's say like the propagation from headline inflation to the underlying inflation trend, etc. So in this sense, if the U.S. economy performs more strongly than our U.S. economics teams expects, or if the yen depreciation significantly, in that case, as our risk scenario, BOJ may begin to emphasize upside risk to the inflation trend again. And then in such a risk case scenario, a rate hike at the December or January meeting becomes a plausible risk scenario. Going forward, we also think that it's very, very important to monitor how the BOJ's internal discussion frames U.S. economic outlook going forward. The key event would be around probably like a BOJ Tankan survey, regional branch managers meeting. So these kind of things would be a key event for us to gauge what kind of scenario was developed internally at the BOJ. So it would be important. And then the effects from the raising interest rate on the real economy side, even if the interest rates are raised, but the policy rate will remain low anyway. And considering the real interest rate is still deeply negative, so the effect of monetary easing is expected to remain strong. So in this sense, the negative impact on the economy would be limited in our view. In particular, as the inflation gradually slows going forward, and upward pressure on the wage growth is expected to remain strong due to structural labor shortage, which means that real wage growth are anticipated to turn mildly and stably positive going forward, which would be supporting the resilience on the demand side. And another thing, given the recent discussions on the upcoming LDP leadership elections, a newly important factor to consider when thinking about the outlook for the Japan's inflation and monetary policy would be the fiscal policy of the new administrations, in our view. So in this sense, we need to pay attention to various sides, both in the global factor and also domestic factor and also political factor.
Got it. Thank you very much, Masa. I think Sugisaki-san, from your perspective, the chart that you sort of show how the yen movements between different sort of hours was quite stark to me. And I think that when you sort of laid out the catalyst, you highlighted a lot of the external catalysts, right? Like, global risk sentiment, and also if the economic data in the US slows as what we are expecting as sort of like the catalyst, right? And then the divergence between sort of where foreign investors are viewing the domestic political developments. But if I were to sort of focus the attention on domestic developments, other than those sort of like, on the political side, could there be sort of any changes or shifts in positioning or shifts in behavior from whether is it the domestic banking system or even amongst the household sector that could actually potentially catalyze movements in both the JGB and the yen?
Yes, sure. I think the from the positioning perspective, the household continue to export the capital as they basically very like a favor for the U.S. equities, and they invest in the U.S. equity via the NISA schemes. And this type of the flow has been the constantly affects the yen weakness since the year 2024. But on the other hand, if the U.S. equity continue to outperform, in such a case, the pension funds rebalancing will be the other side. I mean, like if the U.S. equity continue to outperform, the pension fund rebalancing would likely be the selling the foreign equity and buy the domestic bond. Such kind of like the pension fund rebalancing flow have been offset. The households the investment to the foreign equity flow, and the FX impact from the domestic side have been minimal. I think this situation will likely continue as far as the U.S. equity continue to outperform the other regions. But we think the yen could be resilient in the event of the risk of moves. Right, in such a case, the domestic bond would likely outperform the equities, which means that the pension fund rebalancing would likely be the selling domestic bond and buy equity. The kind of like flow will likely support the weakness to some extent, and this will likely combine with the consistent capital outflow from the individuals, households. And about the catalyst of the domestic catalyst of the yen to go lower, I think it's obvious that if the BOJ continue to hike the rate and start to have the hawkish communication, in such a case, the kind of like leverage funds yen short position will likely be unwound, and also like if any like a candidate which focus more on the fiscal consolidation will also likely discourage the optimism of the optimism about the yen short positioning, and this also may catalyze the another yen strengths.
Got it. Thank you very much. Kathleen, over to you. There was a question about the Korea investment package, which is part of the tariff negotiation. Can you give us some thoughts about, the size of the package, how achievable that is? And I think also more importantly, how this will be financed, and do you see sort of any implications of the currency?
Yeah, sure. Thank you for that. So we've been getting multiple questions around the implications of the trade deal, especially the investment commitment, and how it could drive the outflow, potentially impacting the Korean won. So what we've been so stepping back, the size of the package. So actually, in total, we are seeing around 600 billion in total investment that's been pledged by the government and also the local corporates. So 350 billion was the trade deal itself. That includes 150 billion of shipbuilding sector spending, and then another 200 across the strategic sectors, semiconductors, the autos and EV batteries, other smaller sector investment commitments there. And then there was 2 weeks ago, the U.S. Korea Summit event. The top 10 chaebols of Korea CEOs actually flew to the U.S. and made additional 150 billion of commitments by Samsung, Hyundai, LG, all these big corporates have made additional commitments. So that actually comes into broadly around 600 in size. So considering the annual average of FDI that U.S. received during the Biden administration, which comes to around 390 billion. So this commitment of 350 initially, and then additional is quite a big size. But we also should remember there's been no timeline that's been committed during the deal. And we still think that the 350 billion, especially the 200 billion, excluding the shipbuilding sector, will be largely driven by the loan guarantees, the lendings, and the corporate reinvestments of those funds that are already in the U.S. So in that sense, we do think the immediate one-time lump sum impact or outflow triggered by this FDI commitment is rather limited. And we do think realistically, the size of an annual outflow that the corporates could actually send to the U.S. Shouldn't be much larger than what we've seen historically, considering the capacity of these businesses, of semiconductor fabs and the auto manufacturers, auto parts, and etc. And that number comes to around 53 billion annually, and especially and that's going to global. And if we were to bring the number just specifically to the US, it's been about half of that, around 26 to 27 billion. So considering that, we do think realistically from 350 billion or even larger commitment made by the corporates, the actual outflow on an annual basis could just move around the 50 billion or so is our current view. But at the same time, Korea has been enjoying a very big trade surplus, especially the current account surplus has been quite strong on the back of the intermediary exports picking up to the U.S. And so just earlier this week, we've raised our current account balance forecast for this year to 5.4% of GDP. So that comes to 103 billion from 99 billion last year. So that structural support remains from the trade side. But what we are also seeing on top of the FDI structural flow that we could see in the next 4 or 5 years is that more recently, with the weaker dollar trend and also the Fed's rate cutting cycle that's coming right around the corner now, that the Korean retail investors have been expanding their overseas bond investments in the U.S. And that number actually came not too negligible. Back in May, it was 6.3 billion, and first half of this year, that figure comes to just double checking 21.5 billion. So that's around 75% of the retail investor outflow that we've seen last year on the bond side. So it's been accelerated. So despite the strong the trade balance or the current account balance backdrop, we think the FDI structural outflow, although we think will be a more scheduled, timely basis, and then this additional outflow from the retail investors on the bond side should limit the downward pressure on the Korean won. So our third quarter forecast that our strategist has right now remains at 1380. And that's what we expect, despite the FDI pressure that we'll see, which should be spread out going forward in the next few years.
Great. Thank you so much, Kathleen. June, just turning finally to you. Thanks for your patience and thank you for the audience for staying with us. I think 2 questions for you. One, what is our house view on the global equity allocation, and I think and also where does Korea sit within that? And I think the second question is also for you is, how is positioning right now? Do you see any trends in positioning as worth pointing out to investors? is there a big divergence between how foreigners and domestic investors are actually thinking about the KOSPI and overall? Jun?
Right. Thank you very much, Eric. So first, on the global side, we are equal weight on global equities, but we are overweight on US. We're equal weight on Europe and Japan. We're underweight on EM. And the big reason why our US strategist, Michael Wilson, is overweight on US is because of the corporate revision cycle, which is the revision breadth cycle looks very strong. And it's driven by a few factors. One is that a lot of the EPS revision was done quite quickly, and the bear market actually ended for the U.S. in probably April, and that right now we're in the bull market, and the weaker dollar is also helping out the corporates in terms of the earnings side. So the earnings revision breadth improving is one of the key reasons why. We're equal weight on Europe, largely because of valuations are a bit rich, but the growth dynamics don't look as good, and the FX also not as conducive. For emerging markets, I mean, we're underweight generally because the tariff factor. Again, we look at the corporate revision cycle also, not again more neutral and negative at this point. And Korea right now we're equal weight, and largely because of the fact that as I was mentioned, the fundamentals haven't really improved yet. So we need to kind of look for that. On the trends, so at the I think it was in April when net foreign fund flows was minus 17 trillion. We're now down to like minus 5 trillion. So foreign investors have actually been buying into KOSPI in the past 3 months after the impeachment trial and also after the elections. So there's been, I think, a bit of a buy-in into the reform, but also we've seen money coming into the semiconductor side because of the AI story. But on the retail, we haven't really seen money flowing here, and it doesn't seem likely that money that's around 125 trillion or so right now in the overseas equity market is probably not going to come back, especially if the U.S. market remains strong. And the incremental money for retail investors will have to come either from free cash or cash being released from real estate side, so other assets. And we believe that's more of a story maybe for 26. After the dividend tax reform happens, and also further changes the real estate policy. So I think the net buyer this year really has been the corporate side on the share buybacks, and we do think that's going to continue. So flow-wise, more of a positive expectation for retail probably in 26, while foreigners, I think, will also be continue to be more of a buyer than a seller in Korea.
All right, got it. Thank you so much, Jun. And I'd like to thank the speakers for sharing their thoughts and their insights. But more importantly to you, the audience, for staying with us all the way through. In the interest of time, we will have to conclude today's session over here. Thank you once again very much for joining. The macro webcast will be on again, same time next week, and we hope you'll be able to join us then. Thank you so much. Have a great rest of the week and a great weekend ahead. Bye-bye.